Welcome back to strategiccorporateresearch.org. In today's video, we'll take an in-depth look at the balance sheet. We'll begin by looking at the conceptual framework that underlies a balance sheet. Secondly, we'll look at a simple example. And then finally, we'll jump back into our examination of Verizon and look at their balance sheet over a 3-year period. So let's get started. Unlike the moving picture of the income statement, a balance sheet is a snapshot of a firm at one point in time. It's also based on double entry accounting, so looks and feels different than an income statement. And finally, by definition, a balance sheet must balance. And this is true both for a firm that's doing very well financially and one that's doing poorly. In terms of the basic formula for a balance sheet, it says that assets equals liabilities plus shareholders' equity. Shareholders' equity is a liability. But let's take a minute and unpack that. A company that needs to raise capital can do it in a number of different ways. It could take out a loan. It will, however, be responsible for paying that loan back as well as regular interest. An alternative is to issue stock. One of the advantages of issuing stock is that there are no regular interest payments. However, the firm is responsible for the value of the shares that shareholders hold. And that's why it's on the liability side of the balance sheet. Shareholders' equity, however, is more than it seems, because it also includes retained earnings. Retained earnings are the funds that a firm carries over from one year to the next. And basically, it's net income minus any dividends paid to stockholders. And it can be a negative, that is, you can bring forward a loss. But here's the important point. Conceptually, retained earnings is very distinct from shareholders' equity, yet it's included in this section of the balance sheet. Fortunately for us, they're listed on different lines of the balance sheet, so we can sort those out. But it is confusing that they're considered in this category together. So let's take a detailed look at the balance sheet. In terms of assets, it's going to define assets in two ways. First are current assets. And current assets are anything that can be easily converted to cash. They're sometimes called liquid assets. And that includes cash itself, accounts receivable, and any inventory. Although, as you know, inventory is valued not necessarily at its retail or wholesale level. There are many different accounting practices in dealing with inventory. There are also non-current, or what are called fixed assets. And that includes things like a building or equipment. And again, these are things that are not easily convertible to cash. And again, you can see why it's important to break down assets into those that are convertible to cash and those that are not. We do a similar thing with liabilities. The current liabilities are accounts payable or any short-term notes that are payable, for example, in less than 1 year. Often in retail, firms will take out short-term notes to fill their stores prior to the holiday season with the understanding that once those items are sold, those notes will be paid back. So those are current liabilities. There are also non-current liabilities, which essentially are long-term debt, the kinds of debt one would take to open new stores, have new distribution systems, things that are not going to be payable within 1 year. So let's look at a simple example. We'll go back to my music example. Let's look at what my balance sheet would look like for my music company. In terms of assets, well, there's the current assets, and that would include the cash that's in my music checking account. It would include accounts receivable, what I'm owed for CDs that I've given to people, and the inventory of unsold CDs. Again, remembering they're not valued at retail level. And there's also non-current assets. There are the buildings, my Barnes studio, as well as the equipment and my recording gear. On the liabilities side, we also have current and fixed liabilities. So my current liabilities are the accounts payable, what I owe the recording studio. Of course, I've paid them. The short-term notes, any kind of credit card balance I have. And then on the non-current side would be the long-term debt, that is the home equity loan I took out to build my studio. And it's actually a good way to think about the difference between current and fixed liabilities. Credit cards we're supposed to use to charge incidentals that we pay off within a year. A home equity loan is borrowing for a much longer time frame. So let's go to Verizon and take a look at their balance sheet. And let me start by noting that first we have assets on this page, and I'm going to page down, and then we have liabilities. What I want to point out is I've circled total assets, 291, and at the bottom of the page I've indicated total liabilities and shareholders' equity. That's also 291. So our balance sheet balances. So let's go back up to the assets part of the page. You can see again under current assets, there's cash. And what have we seen here? Not a great variation over these 4 years in cash. And then there are net receivables, and there's the inventory, and there's the total current assets. And you see that it's gone up generally, some bouncing up and down, but generally gone up from 26 in 2016 to 37 by 2019. Then there's the non-current assets, and here's property, plant, and equipment. And again, you see a fairly substantial investment in property and plant and equipment from 2018 to 2019. Now, I have to point out two other non-current assets that are somewhat confusing, and they're called goodwill and they're called intangible assets. First, let me point out that goodwill is an intangible asset, but it's always listed separately on the balance sheet. Let's start with intangible assets. Intangible assets, as the term suggests, are things that are hard to measure, and they could be know-how, experience, patents, ways of working. Those are intangible, but they are part of a business. The goodwill is another intangible asset. What it really represents is the reputation of a firm. So if you were to buy a convenience store, for example, you'd be buying the store, the inventory, and its goodwill, which is essentially its customer base, its good name in the community. You can actually measure goodwill. If you sell a firm, anything you would receive in excess of what the actual assets are worth would be the intangible assets, the goodwill. So here what we've seen is we've seen actually a drop in goodwill over time here at Verizon and a slight rise in intangible assets. But at the bottom of the page, in terms of total assets, we've seen that they have steadily risen from 244 in 2016 to 291. So let's turn to the liability side. Okay, so we have current debt. And here you see something that's very interesting, fairly modest in 2016, but went from 2,645 all the way up to 10,441 in the most recent years. Accounts payable is about the same, but the total current liabilities have gone up significantly from 30,340 all the way up to 44,868. So a rise in current liabilities, mostly because of an increase in short-term debt. Now, what's interesting is let's go into the non-current liabilities and look at long-term debt. And this is very interesting because they went from 105 to 113 to 105 and down to 99. So maybe what's happening here, and we could do some additional research on this, they're paying off this long-term debt, and the short-term debt is in fact part of this payment process. So we have a total of non-current liabilities. Again, 189, 179, 172, 184 in the most current year. So our total liabilities have gone up slightly from 220 to 228. And there's our stockholders' equity, which has gone up. But look at this retained earnings line, which I think is in many ways the most important thing about the balance sheet. In 2016, they had $15 billion in retained earnings. It went up to 35, it went up to 43, it went up to 53. So what it says is this company now is each year adding a great deal in terms of what are its retained earnings that it's moving forward. So I hope you've enjoyed this overview of a balance sheet. Please look at a number of our other videos on financial ratios, stock analysis, and segment analysis. Thanks very much.